Nick Sleep co-founded Nomad Investment Partnership with Qais Zakaria in 2001, and over the next 13 years, generated 921.1% returns versus the MSCI World Index of 116.9%. To put that into dollar terms that we mortals can understand, if we invested $1 million into the index, we would have earned $2.7 million. But if we invested the same million in Nomad, our investment would have earned $10.21 million. Like many great investors, Nick Sleep found investing from unconventional beginnings. Sleep created unusual mental models that helped him create inventive investment ideas. And when he combined these models with a deep understanding of psychology, steadfast patience, and focus on his investment destinations, he achieved an outstanding track record.
10 lessons from Nick Sleep. We can learn multiple lessons from Nick Sleep's letters, and it isn't easy narrowing those ideas. Sleep's visionary ideas regarding Amazon lay out a roadmap in his early letters. Likewise, his contrarian view regarding Costco remains the conventional thinking about the company. Think long-term. Taking time to consider the implications of moving out of one investment into another helps investors create a speed bump. Sometimes the creation of a speed bump helps prevent panic or emotional actions. Preventing the interruption of compounding remains one of the best methods for long-term returns. Sleep understood this quite well, and his focus remained on the business and its destination. He ignored short-term noise or quarterly earnings results and focused on picking good stocks while ignoring the rest. As long-term investors, we can ignore economic data, quarterly financial data, Wall Street recommendations and sell-side research, daily market action. Focus on the destination. Analyzing the company's destination helps investors ask better questions and understand what makes a company tick or its DNA. He felt the only error one could make was the risk of misanalyzing the company's direction. To help focus on analyzing the direction, ask yourself these questions. Where will Amazon or another company be in 10 to 20 years? What must management do now to reach that destination? What circumstance could prevent Amazon from reaching its destination? Compounding machines. Compounding machines like Costco help investors achieve the results we all desire. Buffett's and Munger's superpowers correspond to identifying compounders and buying them at reasonable prices. One of the great axioms Charlie taught Warren was the power of buying a great company at a fair price, instead of a fair company at a great price. Costco remains Charlie's longest-held investment. He mentions numerous times that buying a company with returns on capital of 6% guarantees you a return not much better than that, regardless of the price you pay. Where investing in a company with higher returns on capital over the long term, you guarantee returns similar to those returns on capital over a longer period, regardless of the price you pay. Nick Sleep understood that axiom quite well and followed it throughout the Nomad investment lifetime. Founders and management. Founder-led companies tend to have more skin in the game and different motivations than hired guns. Often, the challenge drives them far more than money. Consider that Buffett only takes a salary of $100K, leading you to determine that he loves his job and loves the challenge of finding great investments. If you look at the recent history of the best businesses, many of them contain founders, now or in the past. For example, Berkshire Hathaway, Amazon, Costco, Apple, Constellation Software. All of the above remain arguably the best-run businesses and some of the best long-term investments. Each one led by a founder who created the company, drove it to new heights, instilled great cultures, and continually updated or adapted to new challenges. To think of it another way, founders lead the way in the same way coaches lead their teams or head chefs run their kitchens. It's all about performance and striving to become the best. Many of them view it as a game to win. Search for founders or CEOs that operate like founders, and you will stand a better chance of finding a great investment. Scale economics shared. Scale economics shared creates some of the most powerful concepts in investment theory. To help explain this idea, Sleep used the example of Walmart's cost advantage. Walmart's business model offers the lowest prices on everyday stuff, while gaining scale advantages through larger and larger bulk purchases from its suppliers at lower and lower unit prices, driving even bigger savings for its customers. All of that led to more growth and scale for Walmart, and we can extrapolate the same idea to Costco and Amazon. Sleep created his term for this business model, scaled economies shared. This term means that Walmart gained scale, but instead of keeping the profits for itself, it passed along the scale advantages to its customers with lower prices. The passing along of profits dampens near-term profits, but leads to far greater profits down the road, creating value for companies like Walmart, Amazon, and Costco, for example. The above sketch by Jeff Bezos perfectly illustrates the power of scaled economics shared. Sleep suggested that companies sharing their profit would have customers reward them with more sales. Walmart, Costco, and Amazon exhibit Sleep's business model and achieved great success. But the real key to Sleep's success was he noticed that even though investors understood the business model, they still undervalued these companies because they placed too much emphasis on short-term noise. For example, seasonal same-store sales, quarterly margins, business cycle. The focus on short-term noise detracted from the real value, the cost advantage that was so hard for competitors to repeat. Price giveback. Intimately tied to scaled economics shared, companies focusing on price giveback investments actively lower prices for customers. Those price givebacks allow customers to enjoy 2 to 10% savings on their purchases at Costco, compared to shopping at other places. Even though these lost revenue investments don't appear on the income statement, they can dwarf other R&D, sales, and marketing investments. Sleep believed that price givebacks would generate the most enduring investment spending by creating long-lasting customer habits. Lollapalooza Moat. Sleep believed that little things could add up, making a big difference over long periods. He preferred to invest in companies whose competitive advantage stemmed from doing dozens of little things well instead of leveraging one big idea, such as location, brand name, or patents. Compare this idea to scaled economics shared. For a company to outcompete Costco, the company has to execute 1 million little things to compete. A much tougher feat, but also makes that company harder to replace. Charlie Munger termed the phrase Lollapalooza effect during one of his speeches. During that speech, he described several ways psychological biases could combine to determine a person's decisions. Sleep applied that idea of multiple biases coming together through a company's action, creating action by the customer for the company's benefit. Inaction. Portfolio inactivity is an active decision. One of the hardest mental activities remains doing nothing at all. Humans struggle with that idea. We all need to feel like we're doing something to move forward. Avoiding buying and selling, or lots of activity for the sake of activity, is a portfolio decision, and, in many cases, the right one. Only let new companies into the portfolio if they are superior to present companies. Information diet. Garbage in, garbage out. Sleep thought we should spend less time collecting information and more time thinking about factors that make businesses great. He felt that information, like food, had an expiry date. For example, how long does a quarterly earnings report stay relevant? Not very long. Instead, Sleep focuses on the information with the longest shelf life and the highest concentration on the most relevant. Volatility. Ups and downs in the markets will continue as long as there are markets. Resist the urge to sell your winners to buy losers. Or, as Peter Lynch liked to say, don't pick the flowers and water the weeds. Investors have little control over the sequence of good years and bad years, and Sleep didn't trade around his holdings. Instead, he bought and held. For example, he has held Costco for upwards of 18 years. After all, share prices will fluctuate. Mr. Market has a job to do. But business values move far more slowly, and those values will grow over long periods. Charlie Munger likes to say you make real money by sitting on your assets. Investor takeaway. Nick Sleep's letters don't reveal any shocking formulas to success. Instead, they offer a continuation of the same ideas Warren Buffett and Charlie Munger shared over the years. Sleep offers a different take on some ideas, but finding strong companies with enduring moats leads to investment success. Buying those same companies at a fair price will deliver great results over long periods.